Hello dear students, hope you're doing good. Okay, this is the SBR revision folder and I'm going to record it just as the last minute revision. And do you know one thing regarding SBR? That this paper is quite different from the P2 and this is mainly a descriptive paper. So you're not going to have too much calculation in it, although you can have some calculation like 10 to 15 marks. But that will be the calculation that is going to support your argument in defining the accounting treatment. But mainly the examination is not going to be that much calculation based. So I'm going to give some tips and then we'll be having the revision of the standards. So the first thing you need to ensure is that whenever you are having a question like from the section A and the section B, and the examiner is going to require that describe the accounting treatment, advise the directors, advise the finance director, advise the financial controller, advise the management regarding the accounting treatment. So make sure you are writing the specific accounting treatment. Most of the students are doing this mistake that like for example, if there is something they have identified that, okay, this is related to the IS-20 government grant. So they are writing the complete government grant writing rather than writing the specific accounting treatment. So first of all, you need to make sure that you are writing the specific accounting treatment. Like for example, if they are saying regarding the revenue grant, that the company has received the grant for the in compensation of the wages and salaries, then although you can first of all start with writing up that the government grant can only be recorded if it will be received, an entity will comply with the conditions attached to the grant. This is the condition which is related to the government grant. And then you will be writing that this is the revenue grant as this is for the compensation of the wages and salaries. If it's, for example, if it is for 2-year period, then it should be recorded as deferred income and liability and should be amortized when the performance obligation is satisfied. That means that the required condition is being met. So the thing is that you need to write the relevant accounting treatment rather than writing the whole standard. Second thing is that relate to the case study. That whenever you are writing, although we did some question in the full course, and the objective of those questions were to define that how you're going to relate the accounting treatment with the case study. Remember, like okay, continuing the same example. Like for example, if they are asking regarding the accounting treatment, if they are asking regarding the accounting treatment. So I was saying that, for example, like you have, when you are going to write the accounting treatment, so make sure that you are relating that with the case study. Like say, for example, if the amount of the grant is mentioned, like say, for example, if it is 5 million, so you are going to write that the grant of the 5 million is received to the, and like company, if the name of the company is mentioned, then you should use the name of the company as well. So make sure you are relating the accounting treatment with the case study. Otherwise, the examiner like will have a flavor that you are just writing what you have crammed and you are not just relating that thing with the case study. One more thing is like whenever you are explaining the accounting treatment, like if you are good in the double entries, journal entries, and you can write that, that will create a very good impression. Like say, for example, if they have received the grant, then you can write debit cash, credit deferred income. And like for example, if 1-year condition are satisfied, then debit deferred income and credit income. So if you can depict those things in the form of journal entries, so it will actually not only save you time, like for example, by explaining, there are 2 ways. One way is to explain in the narrative form that the deferred income should be recognized and it should be amortized. And the second way is to just write the double entry. So there are 2 ways. The double entry is the most simplest way, journal entry. And if you see the news stream, and if you see the answers of the kit as well, exam kit, you will see that they are just using the double entries, journal entries to describe the accounting treatment. The third and another important thing is do required calculation related to the case study. Like say, for example, this amortization of grant, or for example, if there is some borrowing cost, or for example, there is some gain or loss, for example, there is some revaluation gain or loss, or for example, there is some share-based payment expense and obligations. So things like that, or for example, there is some deferred tax. So if there are some calculations, make sure you are doing that. And then not only you are doing the calculation, you are showing it how these are made, you are relating that with the case study. Again, I will recommend, like for example, if you are doing some calculations and you can depict those things in the form of journal entries, then it will be a very good thing to show up in the exam. So make sure that you are doing these three things. The first thing is writing specific accounting treatment. The second thing is relating to the case study and doing required calculation, again relating that with the case study. One more thing important for the exam is like obviously you will be having a 100 marks paper, and the first thing is to get the 50 marks. Obviously everyone wants to secure their pass first. So the first thing is that you need to secure your 50 marks. So remember one thing, that obviously there are going to be some points which you may not get at the first place. Like for example, there is some point that you are not picking up which standard to write, or for example, there is some part related to the current issue, like for example, like that, and you are not aware of that, for example, then there is no need to be worried about. All you need to do is to get 50. And if you focus on two main questions, which actually is the question number one, and then you have the section B, then you can easily get near to your passing marks, and then you can score some marks in the other questions as well. So make sure you are just trying to get 50 first, and if you know all the paper, then that's very good. If you can score good, then it is highly appreciable. Now the next step is that we'll be discussing some main standards, and when I'm talking about the main standards, that means which are hot favorite for the exam. So the first thing is that we are talking about IAS 12. Okay, remember one thing, that in the exam, when you are having the taxation standard, that will be primarily focusing on the deferred tax, because obviously this standard has two portions in it. One is the current tax and the other is the deferred tax. And you know what is the deferred tax is actually the differences in the accounting profits and the taxable profits of the carrying values of an item and the tax base. Carrying value which we have recognized in our financial statement, and the tax base is something which is for the tax purpose, because there are many things which the taxation authority does not consider at all. That here's the permanent differences which we are not going to account for, and then we have some temporary differences which gives rise to the taxable temporary differences and deductible temporary differences. But obviously the examiner is not going to ask you the deferred tax straight away. You will be having the specific situation in the exam, and in relation to those specific situations, you are required to write their deferred tax implication. Like say for example, if you are talking about the revaluation, and when we do the revaluation, the carrying value of an item becomes bigger than the tax base, and that gives rise to the deferred tax liability. So similarly, for example, if they're having some investment property, then the same treatment of the deferred tax liability. Then again, this is something very important, the share option schemes, and I will recommend you to learn it specifically. That when you have the share-based payment, when you have these share option schemes, then there is a deferred tax asset on that. So deferred tax asset is like something, this delayed tax relief means the equity settled share-based payment give rise to the deferred tax asset. So this type of things in the exam, like for example, then you need to learn this, where the amount of the estimated future tax deduction exceeds the accumulated remuneration expense. This indicates that the tax deduction relates partly to the remuneration expense and partly to the equity, and the double entry to record this thing is as follows. So in the exam, like for example, if you are having the share-based payment thing, the examiner can ask you to define the deferred tax implication of this as well. So make sure you are learning it and you are writing the correct treatment. Similarly, in case of tax losses, there is a deferred tax asset. In the fair value adjustments, you have the deferred tax liability. And then you have similarly provision for unrealized profit. This is upon consolidation. So this can be asked regarding IFRS 10, that when there are some unrealized profit, what is the deferred tax implication? So when it comes to the IAS 12, you need to know the specific situation. These are quite important for the exam. The one way or the, at least 20 to 30% portion will be based on the standard which you have already studied in your F7 exam, and I'll be classifying them as F7 standards. One of the main important standard is IS16 property plan equipment. Like for example, the main one is relating to the classification of these non-current assets. Like for example, if they are buying some asset, if they're buying some asset for the business use, and that is known as the property plant and equipment, initially it should be recorded at cost, and the cost has different components. The cost has the cost of purchase plus any cost to bring the asset in the working condition. So that includes your borrowing cost, dismantling cost, non-refundable duties, variable overheads, installation, one-off testing, professional fees, all these should be capitalized. And in the subsequent measurement, you have two models, the cost model and the revaluation model. In the cost model, we carry the asset at the carrying value, and in the subsequent measurement, we go for the revalued amounts and then subsequent depreciation. And in the revaluation, you need to stick that to the continuity, that when you are following the revaluation model, that should be consistent. That should be consistently followed, and gains and losses go to the other comprehensive income. Similarly, as I already described, that there will be a deferred tax implication on the revaluation as well. Then there is somehow dismantling cost that should be recorded. Decommissioning, dismantling, according to IS 37, IS 30, IS 16, debit asset and credit provision for dismantling. And similarly, if like for example there is some overhauling, such as major inspection, that should be capitalized as a separate component and then should be depreciated systematically. Similarly, if there are some disposals, and then if the control has been transferred, then asset should be removed and the gain or loss should be recorded in the profit or loss. This is like one of the important standards. Then comes to IS 19, and again I am expecting this standard in the current exam. You can have that. IS 19 employee benefits. Examiner can give you some calculation, which I'll be discussing that in a while. There are four things the standard describes. The first thing is the short-term benefits, but that is quite simple. There's no need to know something big about that. Like salaries, benefits, bonuses should be expensed out in the current year. Then you have the termination benefits, such as severance payments, and that should be again recorded when there are some terminations. Then you have some long-term benefits, such as long leaves, and then the main thing in which you have in this standard is the post-employment benefits. When you're talking about the post-employment benefit, then you have defined contribution and defined benefit. In the defined contribution, the contribution is defined, and that is the only responsibility of the employer, and that is the expense of the company. When it comes to the defined benefit, the ultimate benefit is defined by the employer. So that means the employer has two responsibilities. The first is the regular contribution they will be making in the plan asset to meet their plan obligation. And the second thing is that if their plan assets are not sufficient enough to meet their plan obligations or liabilities, then they need to inject some further funds into it. And that is the liability of the employer as well. So like when it comes to the defined benefits, so you need to know three things. That first of all, in the balance sheet, either it is a plan asset or the plan liability, because if the plan is in surplus, it is the asset. If it is in the deficit, then it is obligation. The second thing is that asset ceiling. Like for example, when you're recording the plan asset, then there is a concept of asset ceiling. That means like you can record the asset at the value which is recoverable. That means, like for example, there are two things. When your plan is in surplus, the employer will be doing two things. One of them, like either they will be taking out some funds from the plan, or they will be stopping some contribution for a specified period of time. Whatever they are doing, whatever the amount they're going to recover from it, that should be recorded as the asset. And then you have the what should be recorded in the statement of profit or loss. So that should be the current service cost, past service cost, any curtailment gains or losses, any settlement gains and losses. That should be and the net interest. And in the other comprehensive income, there is a remeasurement gain or loss. So make sure, like for example, if you're having a calculation, then you will be given the opening balances of the assets and liabilities. Similarly, the closing balances. The net interest is applied on the opening balances component, and then you have the benefit paid, which will be left alone because when you are paying the benefit, there will be a reduction in the asset and the liability at the same time. So we are not going to show any impact. We'll be just writing the performer, and then you have this balancing figure, net remeasurement gains or losses. So this is a quite simple calculation. Opening balance of liabilities minus assets, closing balance of minus assets. Then you will be recording net interest is applied on this component. There will be a percentage given to you in the exam. And then you have the service cost component given, contribution to the plan given, benefit pays no adjustment. If there is curtailment, okay, curtailment is like, for example, if there are redundancies, there's a significant change in the plan and the number of employees are going to be less, then there is the curtailment gain or loss. If that should be recorded as well. And then you have this component. So make sure when you are having this thing and expecting this standard in the exam, so IS 19 employee benefits. IS 20 is again an important standard, and first of all, grant should be recorded when it will be received, and entity will comply with the conditions attached to the grant. So there are two types of grant. If they are supporting you, like they're helping you to purchase of some asset. In case of asset, they're supporting you, that is the capital grant. And then if they're giving you a grant for in support of some expenses or to achieve a non-financial goal, then that is actually liability. Oh, sorry, that should be, that is known as a revenue grant, sorry. So capital grant has two treatments. The first thing is that you can deduct the cost of an asset grant from the cost of an asset, and income will be recorded in the form of reduced depreciation charge. And the second thing is you can record it as a deferred income. So deferred income means that when you receive the grant, you record it as a liability, and you will be recording the asset separately, the liability component separately, depreciation separately, and amortization of grant. Amortization of grant is the concept that once you have recorded the liability, like for example, if it is for 5 years, the condition is for 5 years, then you will be recording the deferred income. And every year when you meet the obligation, when you comply with the conditions, you will be debiting the deferred income and crediting the profit or loss. That means you are recording it as income. Similarly, when you have the revenue grant, it should be recorded as deferred income and again amortized. If the conditions are not complied, then the repayment of grant provision should be recorded according to IS 37. Then you have another important standard, which is IS 21, and it has two components in it. And again, this is something which I am expecting in the current exam. You may have something regarding IS 21 in the exam. The first thing is in relation to the individual transactions. Like for example, if you're talking about the individual transactions such as import and export, so if they are doing some import and export, then their balances should be translated into the functional currency using the spot rates, and then when they are settling up the transaction at the settlement date, it should be retranslated, and gains or losses goes to the profit or loss. And similarly, if there are some unsettled balances at the year end, then only monetary items such as cash, such as receivables, payables, and loans. Sorry, such as receivables, payments, and loans should be retranslated using the closing rate, and again, gain or loss goes to the profit or loss. And remember that we are not going to retranslate the non-monetary items such as inventory and non-current assets such as intangible assets. We are not going to retranslate it. And the second factor is like the subsidiary factor, that you have the foreign subsidiary, and then how to determine the functional currency. Okay, the simplest rule is the functional currency is the currency of the primary economic environment. That means in which the company is going to carry out its economic activities, such as in which the prices of the goods and services are settled, such as in which the Competitive forces and regulation determine the selling prices, in which you pay the labor, their wages and salaries, in which you finance, you have having the financing component. These are the main things, and you can expect that the examiner may ask you what are the factors that determine the functional currency. Then you need to write these things in the exam. Okay, the second thing is that, okay, additional factors, and this is for primarily the foreign operation, the foreign subsidiary, and you can expect this question again in the exam. Like, for example, how to determine the functional currency of the foreign operation? Then you need to see whether that foreign operation has the autonomy. Autonomy means whether they are under the control of the parent company and they are doing according whatever the parent company is saying, or they have the significant autonomy. They decide their own prices, they sell, they decide where to sell and how to sell. So if that is written in the exam, that for example, they are determining main things for themselves, that mainly they have the autonomy. Similarly, the level of transaction between the two, the parent and the subsidiary, whether the foreign operation generates sufficient cash flow to meet its cash needs, so that again shows the autonomy, and whether its cash flow directly affect those the reporting entity, that means that it's dependency on the parent company. So that means these factors will determine additional factors determining the functional currency of the foreign operations. So remember this thing in the exam. So when the functional currency is not obvious, management uses judgment to determine the functional currency. And these are the few things you need to know regarding yes, foreign operations. This was something very important, yes. And one more thing. So when you are talking about the consolidation, remember one thing. The consolidation is actually the same thing. Like, for example, the principles remain the same, that when you are, like, for example, consolidating the subsidiary or the foreign subsidiary, but foreign subsidiary should be, first of all, translated. When you're talking about the balance sheet, the closing rate should be used. And when you're talking about, the assets and liabilities, so closing rate, and we're talking about the income statement element, then that is the actually average rate, or the date of transaction rate, spot rate. So remember one thing, for the consolidation purpose, you are going to take the closing rates for the balance sheet items and the average rate for the income statement elements. And furthermore things, when you have consolidated, so there are a few things, like goodwill was calculated, goodwill on acquisition, and goodwill on acquisition. And then you have minus impairment. And then you have goodwill in the statement of financial position. Similarly, when you were calculating the net assets, those net assets were net assets at acquisition and at reporting date. So these are the two things that should be retranslated. When you were calculating the goodwill on the acquisition, and then you are having the impairment review at the year end, and then you have this goodwill in the statement of financial position, that means there will be a difference between the values. So this goodwill balance should be retranslated using the year-end rates, and this goodwill on acquisition on the acquisition rate, that will give you rise to the gain and loss, and that gains and loss goes to the other comprehensive income. Similarly, when you calculated the net assets at acquisition, and then you are calculating the net assets at reporting date, so again there will be a difference. Because at acquisition rate, you are using the acquisition rates, and now at the reporting date, you are using the balance sheet rates. So there will be a difference that goes to the other comprehensive income. So the simplest method to do that is that you remember that you are having the goodwill on acquisition, okay? Goodwill on acquisition. And then you are having the impairment, which is the income statement element. Then you have already calculated the goodwill on reporting date. So what you need to do is you have the foreign currency, such as dirham. Okay, then you have the exchange rate, and then you have, for example, the dollars. So you have calculated goodwill on acquisition using the acquisition rate. Impairment is again the income statement element. So average rate. Similarly, you will be calculating the goodwill on reporting date by the closing rate, and then there will be a balancing figure. That is the exchange gain and loss that should be recorded in the other comprehensive income. Similarly for the net assets. Similarly, you will be doing the same working for the net assets. And one more important thing is actually the overseas loan. And this is again an important thing for the exam. Okay. Again, when you have taken the loan, that is a different date. And then if you have settled it, there's a different date. If it is unsettled, there's a different rate. So the overseas loan should be initially translated into functional currency using the spot rate. Obviously, there's the date in which you have taken the loan. The finance cost is the income statement component that should be translated at the average rate. The cash payment should be translated at the historic rate because that is the settlement date. The loan is a monetary liability, so it is retranslated because it is the unsettled transaction using the closing rate. All exchange and losses goes to the profit or loss. This is quite simple treatment, and you can expect this in the exam. So if you're having a calculation, so this is not a rocket science. Say for example, you have taken the dirham, converted into the dollars using the spot rate. If you are making the payment, then again record it using the settlement date. Then just like for example, you took the loan. This is dirham, and this is exchange rate, dollar to dirham, and this is dollars. So say for example, you took the loan, then you converted into dollar, then you made some payment. Again, you will be using this thing, and then you have the closing balances, which is your unsettled, and then there will be a balancing figure showing the gain or the loss. So this is the simplest way how you need to record the IS 21, and again, this is important thing for the exam.